Hey everyone, welcome back to the channel. So what we're looking at here is the real estate market, specifically looking at the housing market. Next week we're going to talk about commercial real estate. Today we're talking about housing. We're talking about mortgage rates. We're talking about home prices. We're talking about the probability or the likelihood that you're going to be able to get a home mortgage. And we're going to try to cover all of that in today's video. So if you're new here and you want to learn more about personal finance, make sure you hit the subscribe button, drop a like on this video if you find it valuable, and let's get started here and talk about, first of all, some of the good news, some of the potential silver linings, or some things that we can think about that are in a positive light about the real estate market during this recession, during 2020. And then in the latter half of the video, we're going to discuss some of the concerns that some of us have about the real estate market, potential predictions about home prices, whether you are thinking about buying a home, whether you're a landlord, whether you are thinking about selling your home. These are going to be some very important things that we need to take into consideration during the 2020 market at the moment. So let's get started here and let's talk about some of the upside, some of the things that we can think about in a good light. One of them being that we do have a shortage of inventory in America for homes. People need a place to live. And so for that reason, real estate is always going to be something that, look, people need a place to live, right? And if you look at the top 3 expenses in America, the number 1 expense for households is housing. It's housing, then it's transportation, then it's food. Housing, people always need to have a roof over their head. It's one of the basic human necessities. And so for that reason, it's likely always going to be something that is going to be very relevant in life. It's not like Enron stock, which suddenly goes to zero, okay? So that is one of the benefits to it that I wanted to bring up here. So if you have a home, it's not going to zero unless it burns down, but hopefully you have home insurance. So the next good thing about this, the next benefit here, is that mortgage rates are relatively low. If we just look in the past 12 months, you can see that the average home mortgage for a 30-year fixed went down almost about 1%, from 4% to in the mid-3s, which is pretty beneficial for people who are looking to get home mortgages. Yes, you're going to be paying less in interest than, let's say, the 1980s, when, of course, there was a lot of inflation back then as well, and there were a lot of other economic factors that went into that. But man, look at those inflation rates and those interest rates during the 1980s. That is quite ridiculous for home mortgages. But yes, so they are relatively low rates, which is a benefit, which means that you're paying less in interest, which could be overall more beneficial. And there's a couple of other good things as well. I mean, people have generally more home equity than what they did previously, which means that they own more of their home, they're less leveraged. But now we're going to get into some of the downsides. Now, I don't know about you, but I've been hearing about people who are doing virtual home tours and then thinking about buying a home online, because obviously you're not going to go out and get a tour of a home during sometime in the end of April here in 2020, because you can't do it because you can't leave your home. I don't know about you, but I don't think I would be buying a home based off of a virtual tour and then saying, you know what, I'm going to drop $500,000 on that house because of somebody's FaceTime iPhone, 480p video of a home. I want to go in, I want to see the floor, see if it's creaking, I want to see if the sink is leaking, if the roof's leaking. You want to actually be inside that home before you buy it. So home sales at the moment are absolutely tanking. We're going to wait to see what the numbers are looking like when they come out in May for April. The bad thing about housing and the bad thing about real estate in general is that a lot of these numbers are delayed. It's not as real time as some of the things in the stock market where we see things very quickly. We see how they're affected. Real estate can take a little bit longer for us to get some of those numbers. It's going to be really interesting to see some of those numbers come out, though. Let's talk about some of the downsides, some of the things that we're very much concerned about. First of all, it's a no-brainer that a lot of people are out of work. And so we see that the amount of people in America who are out of work, it's over 26.5 million people. And you don't have to have a high IQ to take that number, to take the amount of people who are now unemployed and make some type of correlation between the people who suddenly have no income and the people who are going to not be able to pay their mortgage. It's basic numbers to be able to see that there's going to be people who are not able to pay their rent, they're not able to pay for their mortgage. And you have to keep in mind as well that even if a lot of people are renting these days rather than owning their home, well, what happens when they rent? Most likely they have a landlord who has a mortgage for that property. So if you stop paying rent, that does affect the landlord's ability to pay a mortgage as well. Okay, and so for that reason, it's very likely that we're going to see foreclosures increase. I mean, that would be foolish to not see that otherwise, unless of course the government steps in, which they do in most cases. But we're also going to see an uptick in forbearance, meaning that people can essentially push off their mortgage payments until later on down the road if they think that would be beneficial. They can talk to the banks about this. And so the one thing about this that I think is somewhat a little bit concerning, a little bit scary, is thinking about with forbearance is that let's say that you have a mortgage of $2,000 a month and you go into forbearance for 6 months, you don't owe that mortgage payment. Suddenly at the end of that 6 months, you're going to owe that $2,000 a month times 6. You're going to owe $12,000 at the end of that 6 months lump sum. If you can't pay that, you're in a pretty sticky situation. Now keep in mind that a lot of banks, they don't want to foreclose on properties because this is just a big mess for the banks, for the people. Nobody really wins in foreclosures. And so it's one of their last resort options to do. And another thing that the bank might want to do is they might try to get you into some type of plan where they're just going to add a couple of months of payments onto the end of your mortgage rather than having you go into foreclosure. They're going to try to find some other things, but it is still very likely that we're going to see foreclosures in 2020. We're going to see more foreclosures in 2020. And I think it's really going to be affected in certain markets more so than others. This is usually how the housing market works in general because we're going to have different bubbles. We're going to have different areas that rely on certain industries that are hit harder. For example, Las Vegas. Most of Las Vegas in some way relies on tourism or gambling or some type of entertainment. And so if that tanks, if that goes down to zero, if there's no people going to Las Vegas, there's no tourism, that can absolutely crush certain real estate markets, as well as looking at other ones as well. Let's look at Houston, for example. I think Houston's going to have a lot of problems considering the price of oil and the amount of oil companies that are probably going to go belly up. The price of homes in Houston, it's very likely to see them drop possibly a lot more than other places that might be more solidified in terms of their industries that were not affected during this current recession. So keep that in mind. Based off of where you live, might be affected more or less depending on where you live. Okay, so I'm willing to argue that one of the largest factors that is going to drive down home prices in 2020 is the fact that it is going to be much more difficult to obtain a home mortgage based off of your credentials than what it was previously. So let's take, for example, looking at JP Morgan, some of the new guidelines that they've rolled out about 2 weeks ago now. They said that they're not going to be giving mortgages to people who have a credit score under 700. That's one of their rules. They also set forth a number of other rules. I'll throw up some of those right here just so you can see them. You can pause this video if you want to kind of read over some of these. But you're going to see a lot more tightening from banks and financial institutions. And I think what's going to happen is a lot of other ones are going to be rolling this out as well because they need to tighten this because there's a lot more economic uncertainty. This is what happens during these times. But some of these are really going to hurt people's ability to actually be able to obtain a home mortgage. So if you had a 650 credit score and maybe you wanted to only put a few percent down on a home in 2019, you could probably do that. You want to do that in 2020? Different story. And so this is basic economics. Looking at the numbers, we can see that if there are less people eligible to get home mortgages, there's going to be less buyers on the market. And when there's less buyers on the market, home prices are probably going to falter, or at least in part. So let's take, for example, let's say that in 2019, there are 20 prospective home buyers for a property. Let's say somebody lists a property in your local community, and there's 20 people who are interested in it. Now, let's take those same 20 people and look at them in 2020. Well, considering that we just had almost 26.5 million people who are now out of work in America, let's say from those 20 people, let's say 5 of them are out of work or their businesses aren't doing so well anymore, so they're not going to be interested in this home. So now we have 15 people who are interested in this home rather than 20 people from 2019. Now let's take from this 15 people, let's say that out of those 15, let's say 5 of them don't have a credit score above 700. They have not very good credit, maybe mediocre credits. So 5 of those, suddenly we have 10 people who are prospective buyers in 2020 rather than 20 people who are prospective buyers in previous years. So what this does, I don't know if you've ever been to an auction house, but if you go to an auction house and you see that it is half full when there's only half of the capacity, you're going to know that you're getting some pretty good deals with this. Trust me, I've been to a lot of auctions. You're going to know you're getting some pretty good deals when there's not very many people in that auction house. Same thing goes with real estate. If there's less people who are interested in buying the homes, although some sellers might just decide, you know, we're not going to sell, we're just going to wait until this becomes more so of a seller's market in a couple years, perhaps, right? But in general, you're going to find better deals. You're going to be able to negotiate with the seller more and potentially even bring that price down further because there's less people that you are fighting against, less people that you're bidding against because there's less people eligible to actually buy that home. That's going to be one of the biggest drivers for the decrease in prices for houses. Now, how much of a decrease are we going to see? Look, I'm not a genius. I'm not some type of guru who's going to tell you that home prices are going to collapse and we're going to see a 40% decrease in home prices. Honestly, I don't know. And if you're a genius, please leave your thoughts down below. I would love to hear them. But that's the honest truth. It's too difficult to give you precise numbers of what's going to happen with the housing market. But I think it's pretty much a no-brainer that we are going to see housing prices decrease for at least the short term unless we have some massive rush of people coming out who've been waiting to buy a home and suddenly just have all this money saved up and also are eligible for a mortgage and just all dump their money in once this blows over. But I don't think that's going to be the case. Now, let's talk about government bailouts because honestly, this is something that the Fed and the government really loves to do. Anytime that you think that something is going to and that the markets are going to or that the economy is going to blow up, suddenly the Fed steps in, the government steps in, they just start money printing, right? Just start printing money and it seems to fix our problems. It kind of reminds me of when you just start stuffing stuff in your closet and then eventually like you're going to run out of room to put stuff, but they're just going to keep doing it for now. And I guess it's working. But so the final factor that I think a lot of people are neglecting is the travel industry. Looking at the amount of homes in America, which there are millions of this, who were simply made for the travel industry. Think about Airbnbs. I know a lot of people who have a dozen Airbnbs. They've been making a lot of money with them. Suddenly nobody's traveling, and probably through a good portion of 2020, their revenues are going to be hit significantly. I just can't picture some of these Airbnb hosts not going into foreclosure. I think it's going to happen for a lot of them. And so especially in areas where there's a very much a hard travel industry, there's a very large travel industry, they're going to be hit even harder. And I think a lot of people are not thinking about that. They're not factoring that in. The amount of Airbnbs and other different types of vacation short-term rentals that are either going to be vacant and suddenly people are going to be foreclosing on those, or they're going to have to turn into typical residential long-term leases, which could sort of increase the amount of supply that we have at the moment as well, which is really just an interesting point. So thanks for watching the video. Like I said, next week we're talking about commercial real estate. That's going to be a doozy. It's going to be a long one, but it's going to be a good one. So thanks for watching. Thanks for subscribing, dropping a like, and I'll see everybody in next week's video.